Lesson 10. How changes in market volatility should influence money management. One of the most common reasons traders experience sudden declines in performance even while using the same strategy that previously worked well is their failure to adapt to change. Market volatility. Markets are dynamic and constantly shift between periods of high volatility where price moves aggressively each day or week and periods of low volatility where price ranges contract and movements become smaller. And if you do not adjust your stop losses, profit targets, and position sizing to reflect these shifts, your risk to reward profile will become misaligned with current market conditions. When volatility expands, price swings widen, meaning your stops and targets generally need to be placed further away to avoid being prematurely stopped out, whereas during low volatility environments, tighter daily ranges require closer stops and more modest profit objectives. If you continue using wide stops and distant targets during a quiet market phase, your targets may never be reached. And if you keep tight stops during high volatility, you may be repeatedly stopped out despite being directionally correct. Volatility changes not only affect stop distance and targets but also influence nearby support and resistance levels, which naturally expand outward during high volatility and compress during calmer periods. So you must evaluate current horizontal levels in relation to recent price action before placing stops, while tools like the average true range (ATR) can help measure recent volatility. Stop should still be logically placed beyond meaningful support or resistance rather than based solely on an indicator reading. As volatility increases or decreases significantly, sometimes by 30%, 50%, or more over different months or quarters, your money management must evolve accordingly, including adjusting position size so that your per trade dollar risk remains consistent even when stop distances change. If you ignore these volatility shifts, you may risk more than necessary, miss achievable targets, or experience emotional frustration from losses that could have been minimized with proper adjustment. Ultimately, successful trading requires recognizing that markets are living, changing environments, and disciplined traders make it a habit to assess current volatility conditions before entering any trade, ensuring that stop placement, profit targets, and position sizing are aligned with present market dynamics rather than past conditions.